Imagine owning a piece of the world's most dominant companies for just $1,000. Imagine owning a piece of the world's most dominant companies for just $1,000. In today's volatile market, some incredible opportunities are hiding in plain sight. We'll cover a global e-commerce titan, a high-end athletic apparel innovator, and a legendary lifestyle brand owner, all deeply undervalued and primed for growth. These aren't random picks, they're companies with strong fundamentals and massive upside that most investors are overlooking. I'll break down why these stocks are on sale, what could drive their future growth, and how you can position yourself for potential returns. Hit the like button, let's get 1,000 likes on this one, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. First up is Alibaba Group, ticker BABA, a company battered by headlines, but that's where the opportunity lies. Despite the negative press, Alibaba remains a behemoth in the tech world, with a diversified portfolio that spans multiple high-growth sectors. Alibaba isn't just the Amazon of China, it's an entire ecosystem, e-commerce, cloud computing, logistics, and fintech, all serving over 1 billion people. This vast network creates a synergy that amplifies the company's reach and influence, making it a cornerstone of the digital economy. Their platforms, Taobao and Tmall, dominate Chinese online shopping, while Alibaba Cloud leads in Asia's cloud market. These platforms are not just popular, they are integral to the daily lives of millions, if not billions of people. Add in Cainiao Logistics and Ant Group's Alipay, and you're looking at a business with a moat that's nearly impossible to replicate. The logistics network ensures fast and efficient delivery, while Alipay provides a seamless payment experience, further embedding Alibaba into the fabric of everyday life. So why is it so cheap? Regulatory crackdowns and US-China tensions have scared off investors, but the Chinese government needs companies like Alibaba to thrive. The regulatory environment, while challenging, is not insurmountable, and Alibaba has the resources to navigate these complexities. The worst of the regulatory storm seems to be passing, and Alibaba is trading at a single-digit forward PE, absurd for a tech leader still growing and highly profitable. This valuation disconnect presents a unique opportunity for savvy investors. Management is signaling confidence, buying back shares aggressively, and sitting on a fortress balance sheet. This financial strength gives Alibaba the flexibility to invest in new ventures, weather economic downturns, and return value to shareholders. The company is restructuring into 6 business units, unlocking value and making each segment easier to evaluate. This move is designed to streamline operations and highlight the intrinsic value of each business unit, potentially leading to higher valuations. If the market starts valuing Alibaba Cloud like other global cloud players, the upside is huge. Alibaba Cloud is not just a regional leader, it has the potential to become a global powerhouse in cloud computing. Risks remain, geopolitics, China's economy, but the stock price already reflects peak pessimism. The current valuation seems to price in a worst-case scenario, leaving room for significant upside if conditions improve. Any positive news on regulation, US-China relations, or Chinese consumer spending could send shares soaring. Even a slight easing of tensions or regulatory pressures could act as a catalyst for a substantial rally in the stock. Alibaba's international expansion, especially in Southeast Asia, adds another growth engine. The company is making significant inroads in these markets, which are poised for rapid digital transformation. Their relentless R&D in AI and tech keeps them at the cutting edge, ensuring future revenue streams. Alibaba's investment in technology is not just about staying relevant, it's about leading the next wave of innovation. Financially, Alibaba is rock solid, more cash than debt, strong free cash flow, and the flexibility to invest, buy back shares, or weather downturns. This financial robustness provides a safety net that many other companies lack. Sentiment is at rock bottom, but that's often where the best opportunities are found. When the market is overly pessimistic, it can create buying opportunities for those who can see beyond the immediate noise. If Alibaba is simply re-rated to a normal tech multiple, the upside is significant. The current valuation does not reflect the company's true earning potential and growth prospects. Over 1 billion active users are deeply embedded in their ecosystem, a priceless asset the market is ignoring. This user base is not just large, it's highly engaged and loyal, providing a steady stream of revenue. Management is focused on rewarding shareholders, closing the gap between intrinsic value and market price. Their strategic initiatives are designed to unlock value and drive long-term growth. E-commerce is still in its early innings in China and emerging markets, and Alibaba is the undisputed leader. The potential for growth in these markets is enormous, and Alibaba is well positioned to capitalize on it. To sum up, dominant in multiple sectors, fortress balance sheet, deep value, and a management team unlocking shareholder value. Alibaba's diversified business model and strong financials make it a compelling investment. This is a classic contrarian play, uncomfortable but potentially very rewarding for patient investors. The best opportunities often come when sentiment is at its lowest. Alibaba is a rare opportunity, a world-class business at a bargain price. The current market conditions have created a unique entry point for long-term investors. The best investments are often made when they feel the hardest. It's during these times of uncertainty that the greatest opportunities arise. If you can stomach the volatility, Baba could be a game changer for your portfolio. The potential rewards far outweigh the risks for those who are patient and have a long-term perspective. Don't let scary headlines blind you to the fundamentals. The underlying business remains strong, and the current challenges are likely temporary. The market's fear is your friend here. When others are fearful, it can create opportunities for those who are willing to take a contrarian stance. Alibaba's story is about resilience, innovation, and long-term growth. The company has a proven track record of overcoming challenges and emerging stronger. The restructuring could be a catalyst Wall Street hasn't fully appreciated yet. This move could unlock significant value and provide a clearer picture of the company's diverse operations. You're not just betting on China, you're betting on the digital future of Asia. Alibaba is at the forefront of this transformation, making it a compelling investment for those looking to capitalize on the region's growth. Alibaba is currently trading at what many analysts would consider a significant discount. With a market capitalization of $36.99 billion, the company posted a strong earnings per share of 55.20 yuan, and boasts a rock-bottom price-to-earnings ratio of just 1.95. In 2024, Alibaba generated an impressive 996.35 billion yuan in revenue, alongside a net income of 130.11 billion yuan. Despite these strong fundamentals, the stock is trading at $117.07, which is about 18.5% below its estimated fair value of $138.68. For investors looking for undervalued large-cap plays, Alibaba may be worth a closer look. For those willing to look past the noise, Alibaba stands out as a generational value play. The company's long-term prospects remain bright despite the current challenges. Remember, fortune favors the bold, especially when the fundamentals are this strong. Taking a calculated risk on Alibaba could pay off handsomely in the long run. If you're looking for a high-reward, high-conviction idea, Alibaba deserves a spot on your watch list. The potential for significant returns makes it a compelling addition to any portfolio. The next few years could look very different for this tech titan. As the company continues to innovate and expand, its true value will become increasingly apparent. Sometimes the best bargains are hiding in plain sight. Alibaba's current valuation offers a rare opportunity to invest in a high-quality business at a discounted price. Alibaba is one of them. Will you take advantage? The decision to invest now could be a pivotal moment for your portfolio. That's the question every smart investor should be asking right now. With its strong fundamentals and growth potential, Alibaba is a stock that deserves serious consideration. Let's move on to our next undervalued powerhouse. Stay tuned. Next up is Lululemon Athletica, ticker LULU, a premium brand that's not just dominating the athleisure market, but also redefining what it means to be a lifestyle company. With a reputation for quality and innovation, Lululemon has carved out a unique space for itself, and right now, it's offering surprising value for investors. Lululemon isn't just about yoga pants, it's a full-fledged lifestyle brand with a fiercely loyal following and serious pricing power. Customers don't just buy the clothes, they buy into the brand's ethos of wellness, performance, and community. That emotional connection is a huge competitive advantage. Their direct-to-consumer model means higher margins and more control over the customer experience. By owning the relationship from start to finish, Lululemon can deliver a seamless, premium experience both in-store and online, which keeps customers coming back. The power of 3x2 strategy is fueling impressive growth, doubling men's revenue, doubling digital sales, and aiming to quadruple international sales by 2026. This ambitious plan is already showing results, with each pillar driving new streams of revenue and expanding the brand's reach. The men's line is booming, and international expansion, especially in Europe and Asia, offers a massive runway. Lululemon is opening new stores in key global cities, tapping into markets where demand for premium activewear is just beginning to take off. Despite recent stock pullbacks over consumer spending fears, Lululemon's affluent customer base is resilient. These are shoppers who value quality and are less likely to cut back, even when the economy gets rocky. The brand's community building, through in-store events, local classes, and partnerships with fitness instructors, creates a moat that competitors can't match. These experiences turn customers into brand ambassadors, deepening loyalty and driving word-of-mouth growth. Innovation is constant. New fabrics, footwear, and expansion into activities like hiking, tennis, and running keep the brand fresh. Lululemon isn't afraid to experiment, and that willingness to evolve helps it stay ahead of trends and competitors. Their digital business is best in class, driving high-margin sales and collecting valuable customer data. This digital edge allows Lululemon to personalize marketing, optimize inventory, and quickly adapt to changing consumer preferences. Financially, Lululemon is a fortress. Net cash, strong free cash flow, and the ability to invest in growth or buy back stock. The company's balance sheet gives it flexibility to weather downturns and seize new opportunities as they arise. After the pullback, Lulu trades at a reasonable valuation for a company with double-digit earnings growth ahead. For a brand with this kind of momentum and profitability, the current price looks attractive. The market is giving you a rare chance to buy a premium growth story at a discount. Opportunities like this don't come around often for brands with such strong fundamentals and long-term potential. While other brands compete on price, Lululemon competes on quality, experience, and community. That's why it commands premium pricing and maintains high margins, even as competitors race to the bottom. Their unique blend of performance, style, and brand loyalty is unmatched in the athletic apparel space. Lululemon has become a status symbol for active lifestyles, and its products are as popular for everyday wear as they are for workouts. The risk? A deeper recession could slow discretionary spending, but Lululemon's core customers have proven loyal even in tough times. The brand's focus on quality and community helps it weather economic storms better than most retailers. For long-term investors, this is a chance to own a best-in-class brand with global growth ahead. As Lululemon continues to expand internationally, its addressable market only gets bigger. Lululemon's story is about innovation, community, and premium positioning. Under CEO 𝗗𝗏𝗦𝗖𝗎's leadership, the company has shown it can execute and adapt, keeping the brand relevant and aspirational. Lululemon is showing signs of being extremely undervalued by the market. With a market cap of $23.32 billion, the athletic apparel brand delivered a solid earnings per share of $14.78 and maintains a relatively modest price-to-earnings ratio of 13.08. In 2024, the company brought in $10.59 billion in revenue and netted $1.81 billion in profit. Yet the current share price sits at $193.33, which is nearly 116% below its fair value estimate of $417.54. This dramatic gap could present a major opportunity for long-term investors. If you want exposure to a high-margin, high-growth retail leader, Lulu is worth a close look. It's a rare combination of brand strength, financial health, and growth potential. Sometimes the best value isn't the cheapest stock, it's the best business at a fair price. Lululemon fits that bill, offering both quality and growth for investors who think long-term. Let's move to our final undervalued pick. Don't miss this one. It could be another standout opportunity for your portfolio. Our final pick is VF Corporation, ticker VFC, a classic deep value turnaround with iconic brands that have stood the test of time. This is a company with a rich history, a global footprint, and a portfolio that's instantly recognizable to millions of consumers around the world. VF Corp owns The North Face, Vans, Timberland, and Supreme, brands with global recognition and loyal followings. These aren't just names, they're cultural icons, woven into the fabric of outdoor adventure, streetwear, and everyday style. The stock has been crushed by supply chain issues, weak consumer spending, and missteps at Vans, leading to a dividend cut and investor panic. The headlines have been brutal, and the share price reflects a company that's lost its way, at least for now. But these brands are resilient, and new CEO Bracken Darrell, a proven turnaround expert, is taking bold action. Darrell's track record at Logitech shows he knows how to revive struggling businesses and unlock hidden value. The plan is straightforward but ambitious: fix Vans, cut costs, pay down debt, and refocus on brand strength. Management is laser-focused on operational discipline and restoring confidence both inside and outside the company. The North Face remains a powerhouse, and Vans has rebounded from slumps before. Timberland and Supreme continue to command respect in their categories, providing a solid foundation for recovery. The dividend, though reduced, is now sustainable and offers one of the highest yields in the S&P 500. For income-focused investors, this is a rare opportunity to lock in a high yield from a company with turnaround potential. VFC trades at multi-decade low valuations, price-to-sales and price-to-book ratios far below historical norms. The market is treating this like a company in terminal decline, but the underlying assets tell a different story. The market is pricing in zero recovery, creating a huge margin of safety. If management can deliver even modest improvements, the upside could be significant. Any positive news, a Vans rebound, cost savings, or macro improvement could spark a major re-rating. the stock is so beaten down that even small wins could drive outsized returns. The turnaround plan is clear: refresh products, improve marketing, and streamline operations. The company is investing in digital transformation and direct-to-consumer channels to better connect with today's shoppers. Direct-to-consumer sales are growing, boosting margins and customer relationships. This shift not only increases profitability but also gives VFC more control over its brand image and customer experience. International expansion remains a long-term growth lever as the balance sheet improves. Emerging markets and new geographies offer fresh opportunities for these iconic brands to reach new audiences. Risks: the turnaround could take time and a deep recession would hurt results, but much of the bad news is already priced in. Investors should be prepared for volatility, but the risk-reward profile is compelling at these levels. For patient investors, the upside is substantial if management executes. This is a classic case of buying when others are fearful and holding through the noise. You're buying world-class brands at a dirt-cheap price with a credible CEO leading the recovery. The combination of brand equity and leadership is a powerful catalyst for future growth. This is a contrarian play, uncomfortable, but potentially very rewarding. Sometimes the best investments are the ones that feel the hardest to make. Legendary value investors look for these moments: great assets, temporary problems, maximum pessimism. This is the kind of setup that has made fortunes for those willing to go against the crowd. If VFC returns to historical valuations, the returns could be dramatic. The potential for capital appreciation is real, especially if the turnaround gains traction. The dividend pays you to wait for the turnaround. You're not just betting on a recovery, you're getting paid while you wait. Focus on the long-term potential, not the current headlines. The market's short-term memory often overlooks the power of brand and leadership over time. VF Corp is a bet on brand resilience and smart leadership. It's about trusting that great brands with the right strategy can overcome even the toughest challenges. With a market cap of just $4.54 billion, VF generated $9.5 billion in revenue in 2024, but reported a net loss of $189.72 million. The company is in the red, yet its stock is currently trading at $11.66, a staggering 115% below its fair value estimate of $25.07. While riskier due to negative earnings, the deep undervaluation might attract contrarian investors betting on a turnaround. For those willing to look past the noise, this could be the most rewarding pick on the list. The opportunity is there for those with vision and patience. Sometimes the best opportunities are hiding in plain sight, if you have the patience to see them through. VFC is one of those hidden gems waiting for its next chapter. To recap: iconic brands, a new CEO, rock-bottom valuation, and a high yield. The ingredients for a classic value turnaround are all here. VFC is the ultimate contrarian play for value-focused investors. It's a test of conviction, patience, and belief in the power of brands. Will you take the leap? Sometimes the best moves are the ones that feel the most uncertain. Let's wrap up with your next move. The choice is yours, and the future rewards those who act with courage and insight. Which of these undervalued stocks stands out to you? Let's finish strong. Your next great investment could be just a click away. Here's what to do next. Dig deeper, do your homework, and remember, the best opportunities often come when others are looking the other way. There you have it: Alibaba, Lululemon, and VF Corporation. 3 unique, undervalued opportunities. The key? Look past the noise and focus on long-term fundamentals. Whether you're looking at global e-commerce, premium retail, or apparel conglomerates in distress, these stocks are showing major discrepancies between current price and fair value, and that's where opportunity often hides. Want to level up your investing? Check out my Value Stocks Investing Master Course, link in the description. For exclusive tips and real-time alerts, join the Stocks Galore Patreon community. Which stock are you most bullish on? Or do you have another undervalued pick? Drop your thoughts in the comments. Like, share, and subscribe for more investing insights. Thanks for watching. See you in the next one. Your financial future starts now.